You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program for you, the busy financial advisor who wants to learn how to implement options into your practice. My name is Mark Longo from the optionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. Let me just say here at the top of the show, if you want to learn even more about options and how to implement them, I recommend you check out the latest edition to the Options Insider Radio Network. It is Options Playbook Radio. Put it on with our friends over there at Trade King, where we break down a lot of these basic options concepts in even more detail and use some nice little sports analogies and sports metaphors sprinkled through there as well. Offensive plays, defensive plays, all that fun stuff. Check it out, Options Playbook Radio. I think you're going to like it. You can, of course, find it everywhere our podcasts are sold, pun intended. And while you're doing that, be sure to check out as well the Options Insider Radio Network mobile app. You can find that in the iOS App Store, Google Play App Store, even the Amazon Kindle Fire App Store. You can, of course, stream all of your favorite episodes of the Advisor's Option instantly from wherever you may be. You can also download them, listen to them on the go, on the plane, on the subway, and even click on that little contact tab to send us some immediate feedback over here to the hosts. We love that stuff, so we look forward to that as well. Check it out, the Options Insider Radio Network mobile app. I think you're going to like it. And joining me on the Advisor's Option program today, starting off, beaming in from the great Nutmeg State, the Constitution State, if you will, my old stomping grounds as well, none other than Mr. Eric Cott. He is the advisor major domo over there at the Options Clearing Corp and at the Options Industry Council. Eric, welcome back to the program, sir.
Mark, always great to be here, and look forward to seeing you down in Texas next month for our OIC conference. And even though it doesn't feel like spring here in the Nutmeg State of Connecticut, the snow is melting. We're anticipating more tomorrow, and maybe we'll get spring sometime in late August.
And that is your official title, is it not? Options Major Domo?
Yes, I think it's Evangelist, it's Duomo, it's the derivative Buddha. There's a lot of things. I mean, I think Mr. Kavanaugh's had some other names for me that since this is a PG show, we won't go into that.
Derivatives Buddha. I kind of like that one, especially with the bald head. I think you can get that. I like that. Speaking of Mr. Kavanaugh, we are also joined by one Mike Kavanaugh. He is a managing partner, principal, jack of all trades over there at RCM Wealth Advisors and RCM Asset Management. Mr. Kavanaugh, welcome back to the program, sir.
It is great to be back with this motley crew of options professionals.
It is indeed quite the motley crew this episode, because sitting in on the old Swan hot seat this episode, none other than one Mark Sebastian, the latest addition to the Swan team over there. Mr. Sebastian, welcome back to the program, sir.
I'm no longer the latest. Since they hired me, we brought in another trader and two new account guys. So we are growing like weeds here at Swan Wealth Advisor. In the next 6 months, I'm going to be like the old man. The way things are growing with us, it's unbelievable. Yeah,
I'll have to introduce you as the senior Swan employee over there from lovely and scenic Durango.
Exactly. Hey, there are worse places to be. Durango is. Have you been to Durango yet? Anybody here? If you haven't been, or if you're an advisor listening in and you're saying, you know what, even I got to go do some potential due diligence on Swan Wealth Advisors. There's no better place to do due diligence than Durango, Colorado. Let me tell you that. Maybe there's some uncharted island somewhere that would be close, but Durango is just unbelievable.
I neglected to mention Mark Sebastian, also brought to you today by the Durango Tourism Board. So many sponsors for the advisors.
That's right.
All right, and with the gang all assembled, we're going to dive right into our first segment. Usually this is where we dive into some basic options concepts, but we also like to take a moment here on the show to keep you apprised of the latest developments in terms of research and events and all that kind of fun stuff coming out of the options market that you may not be aware of as a busy advisor yourself. So we're going to do just that right now with our first segment, The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to The Buzz. This is, of course, where we break down some of the more interesting, more compelling recent developments we've been seeing coming out of the options market that may have an interest for you, the busy financial advisor, as well as for those of you out there who may be looking for a new financial advisor. Interesting stuff going on. And first off, let's start it off. I just came back. It was a big conference week in the world of listed options and futures and indeed derivatives. A lot of travels to the sunny south, talking about a lot of different aspects of the derivatives markets. And I went to a futures-oriented show and then an options risk management-oriented show. And I was surprised at both of those events. First off, how frequently the term advisor came up and was bandied about, whereas in years past, that was really just a non-starter at these types of events. No one really had much interest in that space or really knowledge of it. And yet it seemed like everywhere I turned this year, people were talking about how some aspect of the derivatives industry, could be managed futures, could be options, what have you, relates back to the burgeoning and nascent advisor audience. So that in and of itself, I think for the audience of this program and for us here on the network, it was pretty interesting. I want to start off with some of the interesting things I heard at the Risk Management Conference. This is indeed a conference put on by the Chicago Board Options Exchange every year for a lot of end users, pension funds, hedge funds, and some large institutional investors who want to learn more about how these products like volatility products and S&P 500 products are implemented from an options perspective and how they could use them. Interesting event for that in and of itself, but what caught my eye first off there was they had a keynote speaker from Barclays come on in the middle of the conference, and he was doing a lot of different analysis of different products and the flows that are coming into a lot of these volatility and volatility-related products, like a lot of the big ETPs we've seen springing up in the volatility world, like VXX and XIV and all these other products that have become so huge in the last couple of years. And a lot of the flow in those products traditionally laid at the feet of some professionals as well as a lot of retail. In fact, on our Volatility Views program very recently, one of our guests, Chris Cole, referred to the audience of those products as the shoeshine boys, implying that they are very, very heavily retail-oriented. And yet one of the speakers at this conference, Manish Deshpande, he's a researcher over there at Barclays, had some contrary evidence, which I thought was kind of interesting, and I want to get your guys' take here on the panel about this. He said that, quote, some retail presence in these products like VXX and others, but what he really said is that volatility has shifted from floor brokers and professional traders to RIAs. That was his big point. RIAs and family offices and a few others are really now the primary drivers of demand for these volatility-related products like VXX and others. And that really struck me as odd because we've been playing in this space now for quite a while. We talk with a lot of different facets of the advisor space, and these products, quite frankly, never really come up. So that, to me, at least anecdotally, struck me as a little bit odd, and I want to get your guys' takes on this as well. Eric, we'll start with you. You gallivant across the country and around the world talking to advisors of all shapes and sizes. What is your take on this when you first hear this? Does this jive, for lack of a better word, with what you're hearing anecdotally from advisors? Are they really interested in these volatility-related products?
Mark, a little surprising to me, although I work with Barclays and feel that they have the pulse on what's going on in the market. And I guess with their direction, looking at RIAs and SFOs, single-family offices, incorporating these ETNs as a way to kind of get access to, S&P sort of, short-term. The interesting thing, what I would say corresponds with this is that more advisors are looking for ways to gain access to volatility products, and it's either through mutual funds or separately managed account managers like Randy and Mark and the team out there in Durango, or Mr. Kavanaugh and the group in Chicago. The attention that's being paid to this component as part of an asset, leg or sleeve, Mark, kind of where does volatility fit into my asset allocation model for my clients? Absolutely, more and more of those conversations are coming up. And I'm intrigued to learn a little bit more from my colleagues at Barclays to see that this has become, more of a product for the advisory space, maybe than institutional.
Yeah, we need to get Manish on the show and really pick his brain a little bit about where these numbers are coming from, because this is literally the only place I've ever heard this stat bandied about. And so I need to get a little bit more of a grasp on it myself, where he's getting these numbers from. But Mike, same question for you, because you spend your days entrenched in the advisor space as well, talking to advisors of all different types and shapes and sizes. How does this strike you? Do you think this is actually the case? Are advisors moving en masse into these volatility-related ETPs?
My experience shows that advisors are never the early adopter or first responder to engaging with a new product or new asset class. It generally comes from the push from the client side. If the client says, "Hey, I don't like what you have set up for me," then the advisor goes out into the world and finds a new, new investment for the portfolio. So if the clients are asking for it, then the advisors, in a stretch to not lose their clients, are looking outside of what their comfort zone and how their business is built. For us, what we see is advisors educating themselves, but I don't see huge en masse monies going into the volatility space. And right now everybody's trying to essentially get income in their portfolio in non-traditional means. What we've been seeing is the push into income products that are typically a little bit more risky than a 6-month T-bill or a 10-year note. You had that big debt offering last August or September with Verizon, and I think that was I don't think people really love Verizon paper as much as they love the fact that it was paying 4%, and there's nothing comparable in the bond yield market that is getting people to 4%. So it's interesting that you get some statistics like that study shows that people are en masse moving into a product when the headlines suggest that they're looking for non-traditional ways to capture yield to protect the investments. I don't see a lot of people screaming for it.
Hey, Mark, can I just add something to that, because I think Mike hits a really good point on that. If we look at the advisory space with 40 Act funds and mutual funds back in the late 70s, early 80s, then we look at ETFs that really started to ramp up in the late 90s, early 2000s. Now, obviously, it's $1.5 trillion marketplace. I also want to give a shameless plug here for the the anniversary of the U.S. mini options, which came out last March, which are only 5 names, and advisors are still slow to embrace that. Michael's point, which I never really like to give Mike credit. I don't like to give Kavanaugh credit where credit's due, but advisors are late adopters. And it's interesting that Mike said that too. Clients are driving the conversation, and I'd like to know more from Barclays about that too. If this is something that clients are seeing on some of the CNBC shows, they're hearing about it on, your program, Mark, and they're exposed to this through their friends who might be using it at another firm, and they're calling their advisors and asking about it.
That is a good point that, of course, even if retail is a big component of this flow, it makes sense through osmosis that they would drag some of the advisor space along with them. They would contact their advisor and say, hey, what about these VXX type products or VIX related products? And maybe that would cause some spike in interest in that audience. But yeah, I do want to see more about those numbers. Mark, you're kind of entrenched now in the advisor space as well. You're starting to get more of a handle on who's using what out there and what these different advisors are using. How does this gel with you? How does this sit with you? You spend a lot of time, obviously, also looking at the flows going into products like VXX and the listed volatility products. What's your take on this? Do you think the advisors are really a big driver of things like the term structure we're seeing now in VIX futures and things like that?
Well, all right. So now I just want to, before we start saying that advisors are late adopters, let's kind of quickly talk about why advisors are late adopters. So we at Swan, we're a great alternative, cool, SMA program, and we've got a 40 Act fund. And we have problems with so many advisors, not because the advisors don't want us, but because the advisory firms can't report on option trades and can't report on these various products. So a lot of the blame gets put on the advisors, when often it's some of the advisory firms that are really the underlying problem. So now getting to your second part of the question, just from my experience, I get how family offices and different pieces of that might be seen, but I found that VXX and XIV and some of these products, they've turned into a bit of a hedge fund hotel, where it's the easy, crowded trade that everybody's in. And I'll bet you, and in the last month, we've seen all those firms kind of get out of VXX and out of these, as they got burned pretty bad on in the middle of January. I think a lot of funds learned something that, oh, wait a minute, futures can go backward? What? Vol can go up? I didn't think that was possible. So do I think it's all advisors? Do I think advisors are becoming a bigger piece of this? Yes. And should they? Yes. I think VXX, XIV, all these volatility plays, all these term structure plays have a great could be a great piece of an advisor's approach. Do I think that they're the driver of volume? Maybe the driver in volume growth, probably still not the driver in volume itself, would be where I would come.
All this talk about VXX and these VIX ETPs makes me think it's probably time for a good educational episode on volatility products for advisors, what the proper use case for them is and what it is not. So we don't have a lot of advisors going out there and, let's say, buying and holding VXX for 6 months and then complaining why they're underperforming. So I think maybe an episode like that might be in order down the road here for the advisor's option, if any of this data is true. So that's an interesting stuff to discuss. Eric, you also alluded to it recently. I want to get back to that point you just mentioned about the minis, kind of shifting gears a little bit, but you're right. It is that time. It is the 1-year anniversary from the launch of these products, a much heralded, much ballyhooed launch of a new product in the option space. If any of you guys have been following options for any period of time, you know the minis were couched in many ways as kind of the panacea for a lot of the ills of the options world, particularly on the retail side. Retail volume was still flagging. This was going to be the product that was going to turn that around. This was going to be the product that drove more retail action from an options perspective in very popular names like Apple and Amazon and others that are popular but also very expensive. So therefore out of the realm of possibility for most retail customers who only have, let's say, 30 shares of Apple or whatever the case may be. Now we have a year in the record books from an options perspective on these minis, so we can talk about them with a little bit more clarity, a little bit more hindsight. Eric, we'll start with you since you brought it up. 1 year later, what's your take on the minis, how they performed, and what's the feedback you're getting from the RIA space and the asset managers on these products?
You know, it's interesting. I mean, it is a year, Mark, and with institutions and then retail and obviously advisory, sometimes it takes a little bit of a slow process. I'm excited by it. I just talked about it. I was at a Quinnipiac University program last week with my colleague Joe Burgoyne. There were about 1,000 undergraduates from all over the country there, and talking to them about the innovations in our marketplace. As all four of us know, we celebrated our 40th anniversary last year. First listed option traded in 1973 of April. I was not there. I was still trying to figure out what I was going to do with my life at the age of 7 or 8 or whatever it was. But we fast forward to 2014, and we have innovations, and that's what I like about this industry. It's exciting. Look, you know, the mini contract, it's only on 5 names right now. We'd like to see some others come out. My colleague over at TD Ameritrade, JJ Kinnan, said, that it's a very small percentage of their daily option trading. But interestingly, the advisors, and I just did a program in February where I was out in Florida with a regional firm, very large regional firm. I actually had a advisor after my presentation, and I was there with a derivative specialist, sit at his desk and execute a couple of trades on mini contracts. He didn't even know they existed. So, there's a lot of opportunity. I think we have to get the word out a little bit more. I don't know if it's going to, drive volume away from maybe weeklies or from, flex options, but, it's just another tool that people can use. And I want to obviously comment on Mr. Sebastian's mention about back office compliance. Absolutely agree with him 100%. Having worked at a wirehouse, the one that had the bull as their logo, as I always like to say, very difficult and a timely process to get things through compliance and sales and everybody else till they understand how, option overlay strategies really do fit. They're just easy. I mean, they're more apt to actually put a managed future or a REIT fund in somewhere rather than looking at, a buy right, type of fund that really could, add value to the advisor speaking to their clients. So, the point about the minis, Mark, I think there's more to come from that, and it just has been a little bit of a struggle. There were a lot of expectations, I guess.
But, Eric, that is a good point. And, I've heard that refrain time and again. Maybe we need to have a whole section of this show, maybe its own show, just devoted to advisor tools and system problems that we've seen implementing options on the advisor side, because it is such a common refrain. I heard that again a lot last week at the RMC conference. A lot of people working as sub-advisors or trying to be evangelists out to these funds and other issues like that, and coming back with these same problems. People want to embrace these products. They just physically can't because of all the system limitations that they have. So that is certainly a common refrain and a serious stumbling block here for the adoption of options into the advisor community. But before we shift off the minis, I want to get your take, Mike, as well on this product in general. 1 year later, launched with a lot of fanfare, maybe 1 year later, not really living up to the hype for the most part. What's your take here? Are you hearing a lot of your clients asking for these products? Are they even aware of them? And the advisors you talk to, are they aware of these products, or is it still a lot of education and a lot of other issues to overcome before minis really make it into the mainstream?
I mean, you don't think of exchanges as being innovative, creative companies, but they always are looking to innovate and create financial products that they can add to the breadth of their other products that they offer on the exchanges. I don't know what the numbers are, but I would guess that there are more products launched unsuccessfully than products that actually stick. I'd like to see the research on when they launch these products, whether they're taking a deep dive on the client end to say, hey, would you be interested? Is there a need for this? Versus saying, hey, look at these minis. This is great, and trying to sell it to people that don't need it. I struggle sometimes to find where the need for the mini in a portfolio is. I mean, when you look at options,
is that like the Yugo?
Sort of. I think so. Maybe more along the Adobe, the clay-made car. But you know what I mean? Like I can, Eric, myself, Mark, and you, Mr. Longo, we could probably lock ourselves in a room and come up with hundreds, if not thousands, of creative products. Different expirations, different falls, different expiration periods. But if the client demand side isn't asking for it, then I think you're just kind of spinning your wheels. So I think the exchange, if this isn't taking off the way it is, it's kind of like a round hole with a square peg. I personally can see the benefits on the short-term side for more of a trading perspective than an investing perspective. But I think if you find a product that fits fundamentally into the portfolio of the traditional fundamental users of the marketplace, then everything else kind of builds itself around that. If you're creating products just to get market share and different types of bottom line reports to show value to the shareholder, I think you have less chance of success. So if you go back to the mid 90s when the E-mini S&Ps came out, well, the E-mini S&Ps have a proven value to a hedger who fundamentally has a portfolio, a pension fund that has obligations to send X amount of cash out to the retirees of the pension. Well, they have an inherent need to hedge their stock portfolios using the futures. So they'll go out and put a couple thousand of these things on to hedge a certain strand of their portfolio. And, the market makers, the speculators, the guys that have the funny looking hammer looking things on their charts come in and they start trading off of, market movement. If the minis, I can't figure it out, but there's probably some need. If they find the fundamental reason that they're important to the traditional risk manager, then I think the product takes off. But if we haven't seen it, it's probably because it hasn't found that fundamental place in the portfolio for the traditional user of the derivatives market.
Yeah, I kind of agree with you. I mean, there is a use case I could see for these that is useful and interesting and derives value for the end users of these odd lot traders. But you're right, the way it was implemented was very much in the kind of new product, cash grab, volume grab type of mentality that we see all too often in the world of options, where they kind of just push these down their throat, charging full ticket prices. Really a lot of other issues with the implementation of these products that kind of seem to hinder them from the get-go. Discoverability a year later, still an issue on a lot of these brokerage platforms. I challenge you to find where to trade minis on the vast majority of retail options platforms. They're buried under some non-traditional tab usually in a lot of the options change there. The commission's still a problem. Most people still charging full ticket charges and full commissions for a 1/10 size product. Retail aren't stupid. They understand that they're getting a much smaller size contract. They expect some sort of attenuation of the fees associated with that contract, and yet brokers didn't seem willing to budge on that front. And of course, market makers as a class overall have been just decimated in recent years, and now expecting them to add a new product to their list and take all the commensurate risk and all the commensurate costs associated with listing that, even the one that should be a no-brainer, like a mini Apple product, for example, they just clearly weren't willing to do it until there was some volume. So there was that chicken and the egg type problem as well, which caused the spreads in the minis to be far too wide, wider than the regular options. That problem has been rectified to a degree in the year plus launch, but still a lot of fundamental problems with these products that were kind of perceived as a slam dunk. All right, and then next up, another interesting study I saw presented down there at the RMC, very, very salient to the audience of this program, and I want to get your guys' takes on it as well. This was the Goldman-Sachs study of how mutual funds like to use options. Now, we talk about this a lot in different areas of this show, but here's some actual data on the actual implementation. And they found that in the major fund families, 5 of the top 15 fund families now have funds that use options in some way, shape, or form. 196 funds overall use options, and of those 196, they had more than 480 billion, nearly half a trillion dollars in AUM at the end of last year. The percentage of positions held by mutual funds pretty much fall along the lines you probably would expect from a long-only fund using options. 64% in short calls, so that would be the covered call type positions we've extolled many times here on this show. 22% in short puts. That's good to see. A lot of people starting to awaken to the use of short puts as an alternative to the limit equity buy order. That's a nice thing to see. That's a better way for a lot of funds to enter into positions like that. Only 8%, surprisingly, in long puts, the traditional hedging use case a lot of people think of when they think of mutual funds. They think of mutual funds essentially legging into collars, buying puts and selling calls, and yet only 8% in the long put side of the fence and 6% in long calls. So only 6% using options as some sort of surrogate for the underlying there in their portfolio. And overall, the performance has been very, very positive. Over the last 5 years, they studied ending March of 2014. They found that the funds that used options had higher returns, lower volatility, and higher risk-adjusted returns. So they pretty much win across the board versus funds that don't use options. And that's good because with so many of these funds writing calls, very heavy in the option writing sense, it's good to see that the traditional wisdom around that is, that's going to underperform in the markets like we've had over the past couple of years, a strong bull market. And yet over the past 5 years, these funds that are even heavily writing options, even to the upside, are still outperforming their peers across the board. So that's interesting stuff. Eric, I'd imagine you've had this study in hand now whenever you walk in and knock on the door of a new advisory firm. This must be good ammunition for you guys over there at OIC Advisor.
I have to tell you, Mark, I have to do a little bit more due diligence on the Goldman Sachs study. I mean, we actually, this is not a shameless plug for the OIC, but we released, our quant study to you actually in 2011 down in beautiful Savannah, which was the first quantitative study done on option use by advisors. But what's intriguing about this study, Mark, that you're talking about, we obviously know some of the elder statesmen in the 40 Act space who use overlays like Gateway, Eaton Vance with their ownership of Parametric, obviously Goldman Sachs fund. Absolutely. I mean, there are clearly more opportunities for advisors to look rather than, as I always like to say, rather than being do-it-yourselfers. They're going to be the general contractor, and they're going to seek out, a professional manager to help fill that slot for them. And I think more and more money managers, asset managers are realizing it's really important to start to add this as just a portfolio discipline. Don't, have a small component of it and you don't know about it until you read the prospectus, but really kind of come out in the forefront with advisors and share with them how they can, harness income, or, hedge downside risk. You mentioned the put selling. Obviously we have, colleagues of ours, that we know who are, using CSPs, cash secured puts, as a discipline. I know the group out in Durango as well, and then others who are out in Seattle. So this is something that we've been pounding the table for years about now, that there are more and more opportunities for advisors. And, we're at the OIC just at the forefront of being able to eventually in the next 60 days, we'll probably have a listing on our website, which will start to give advisors a central place to go to at least find out where those funds exist. Not to say that their firm is going to allow that fund to be utilized, but at least they know it's out there.
Mr. Sebastian, same point to you. This is obviously some of the first data outside of what Eric and you guys put together a few years ago. Some of the first real hard data on fund use of options overall. What's your take? Do these percentages surprise you in any way, or is this pretty much what you expected?
Well, it's always shocking. I'm always shocked. I'm always shocked and not shocked at how little concentration there is, and the way options are used. Everybody still thinks that they can just stock pick the market. It's unbelievable. So, but it just shows that there's more education, more work to be done. I anytime that number isn't 100%, I am just flabbergasted. That's my opinion, because it should be 100%.
Yeah, I think all of us here are of that same mindset on this show. Most large funds should be using options, no matter what asset category they're active in. Fixed income, commodities, long equities, I don't care. You should be using options to hedge and generate income and get into those positions. It's just the better way to implement those asset classes. Kavanaugh, I will toss it to you as well, because there's one percentage here that kind of leapt off the page to me. I wonder if that kind of leapt off the page to you. The writing of covered calls, that makes sense. We expect that. Short puts, a little surprising that they would adopt that, but it kind of makes sense. Again, it goes to the income side. But the number that struck me as being way too low, almost alarmingly low, is the 8% in long puts. That means only 8% overall of that nearly $500 billion in assets has any sort of real hedging outside of the nominal hedging value of writing a covered call. Does that alarm you at all? Or is that number pretty much what you expect? Or is that even maybe high?
It doesn't alarm me. I mean, if it's just a straight married put, I don't know a lot of advisors or, sub-advisor or hedge fund managers in general that just do the long married put. It's not an actively managed strategy, because the ability to add alpha is difficult enough when you're stock picking to say, all right, we're going to add an extra 10% basis by buying a put and not doing anything to hedge or offset the cost of that put. If you're a $6 billion hedge fund all the way down to an emerging manager or a sub-advisor, I very rarely meet people that are actually out there just buying the married put. People form opinions and say, hey, I think the market could go down 20%. Well, if it goes down 25%, I don't have a problem selling a put below, 10% below the one that I bought. So if those people are knocked out, so to speak, of that 8% number, I would say there's probably more people using some sort of downside hedging strategy. I'm not shocked by that number, because we don't just buy outright puts without having some kind of mechanism in place, whether it's making it into some hybrid collar, selling call spreads or calls to help finance the put, or selling put spreads or puts below the long strike. I think money managers are creative in that aspect to always be looking for ways to add alpha to a portfolio.
That makes sense. And you guys, of course, are a lot more active than the typical advisor would be from an options perspective. So you're right. You're not just out there buying puts. You're legging into collars, zero cost, or what have you, or you're legging into put spreads and perhaps collars as a way to offset the price of that put. So there's a lot of ways you could do that, but you still have the protection component at the core of what you guys are doing over there. And the 8% of the long puts versus 22% in short puts versus 64% in short calls, that shows that a lot of these other funds are still heavily leaning towards the income side. And they're kind of forgetting about the other very important component of options, which is protection, which is, I would imagine, a very, very desirable use case right now, given the fact that the market's hitting record highs every other session, it seems like. I'd imagine a lot of the clients are calling up and saying, hey, we're getting a little top heavy here. What are you doing to protect me? And I don't think they want to hear that you're just writing a 5% out of the money call, because that's not really going to do it. Eric, last question here on this for you. Does that surprise you, that 8%, or is that kind of in line with your expectations?
I think it's in line with my expectation. I think, the majority of advisors that are out there are predominantly looking at the income side of it and staying really tried and true to the buy right. So, that's not a surprising factor. I'm just excited that Goldman did this study, and I think we're going to see more of this come, maybe from a Guggenheim, might see it from a BlackRock. So I have a feeling, having worked with some of the ETF providers, we'll probably see another study come out, this year, which, and by the way, we are releasing our second study off of the Bellamy, which is our quant study. We will be releasing this summer the second iteration to the OIC Bellamy quantitative study on option use by advisors. Shameless plug there, Mark.
Yeah, good. I'm looking forward to that, Eric, because the more hard data we have on this space, the better I think it is for all of us here to be able to go in and actually have hard numbers to back up our crazy, wild speculation, as we are wont to do here on this program. All right, and that is going to do it for the Buzz segment for this episode. And now we're going to keep on rolling right on into my favorite segments, because it's your segment. Yes, it's time for the listener mail.
Listener mail. Listeners write in. Mailbugs.
All right, and welcome to the listener mail portion of the show. This is, of course, the portion where you guys get your chance to join us here on the Old Advisors Option Program. A lot of great ways for you guys to do that. Of course, you can shoot us an email, questions@theoptionsinsider.com. Find us on social media, twitter.com/options, facebook.com/theoptionsinsider, or leave a comment on the show notes of this program on our website. We'll, of course, route it to the appropriate program. And as a lot of you are choosing to do, click on the old contact tab on the mobile app and shoot us a question that way. It goes right to the host of the show. It's a great way to stay in touch with your favorite programs, like our friend here, Greg S. And he writes in, I'm looking for some advice from an experienced options professional regarding stock replacement using American-style calls. Really, the question comes down to, for a higher dividend yielding stock, should I be buying a leap or rolling out approximately every 3 months after exercising very close to expiration and capturing each dividend? I get that the dividend lowers the price I pay the longer the dated the options are, but does not reflect as much as if the options were available as European style. It seems that if the dividend yield is high enough, the American style can't fully compensate the option holder for the missed dividends, as the value can't drop below intrinsic value. Does this call for the shorter term options to capture each dividend? The caveat seems to be that the rollout should cost more extrinsic value on ex-dividend. Since I have a buy and hold objective, Euro style or warrants would be ideal to avoid transaction costs, but again, not available. So far, I have been rolling an in-the-money call option position on a relatively high dividend yielding stock, about 5 to 7%. I have wanted concentrated exposure in as part of my overall portfolio, but with limited risk. It makes the regular scheduled quarterly dividend payments and the timing of the annual increases is known to occur in Q1 of each year. Well, just yesterday, the day before ex-div, I figured I would skip the dividend capture and roll out the May contract to the August one, cheaper than I could today because today it trades ex-dividend. I confirmed this using the CBOE calculator, holding the price constant. It showed the time value paid to the roll should have been more due today due to the trading without the dividend versus yesterday. Though just eyeing the bid-ask spread didn't appear to do so by much, and the implied volatility looked to be the same. This is a great question, very much a mouthful here from Greg S. One of the reasons why I love this show, we have such a great audience, high-end guys out there looking to implement and learn from what we talked about here on the show. If you have any questions about what Greg is talking about, we covered this topic, stock replacement, on the December episode of last year, 2013. I encourage you to go check that out. We get into all these use cases. But if you're confused, essentially what he's talking about is using some sort of in-the-money call option as a surrogate for a long stock position. And we've extolled that many times here on this show as a great way to improve the capital efficiency of your account and to also add all the Greek benefits you talked about here before, the Vega component, the Delta component, all the other things that protect you against an adverse move in the underlying. And he's also talking about the differences between American style and European style options. We covered that on the show in the past too, but really quickly, American style essentially allows you to exercise that option at any time during the life of that product, whereas European style only allows you to exercise essentially upon the expiration of that contract. So there's two very different structures in there as well. So we covered a lot of this stuff on the show in the past in different aspects. Again, if you're confused, check out some of our archives for more of these different elements. But Mike, I'm sure you get some sort of variation on this theme on a regular basis from some of your higher end clients and even a lot of the RIAs you work with who might want to use this approach but have some questions about implementation. So what's your advice here for Mr. S regarding his use case of American versus European style options in this type of scenario, in a high dividend yield stock that's paying a quarterly dividend and he's worrying about if he's rolling on the proper time frame?
Yeah, well, my first guess is this guy has a background in some form of engineering and should be teaching options classes. And as a way to generate extra revenue, I would argue that this guy could probably teach option courses across the country versus using his own portfolio. You know, I would look at the cost-benefit analysis. So, and that's a joke. It's a great question. I mean, we don't get a lot of questions like this. It's a very involved, question. My only, and maybe things have changed since I've been heavily involved in options, but my understanding with the European options, you find those expirations tend to be with the indexes, like the RUT and the SPX. So I don't really think that, I mean, if you're hedging an individual portfolio and you're using the SPX or the RUT, you better be managing a lot of money, where you're collecting the dividends on the individual stock, and then you're using the actual European style indices options to hedge that portfolio. I think it's just an exercise in futility if you're not managing $50 to $100 million using the European style to hedge. I look at it as the time frame. In theory, what you're trading off, there's always a yin and yang. There's a trade-off. So I think what you're trading between the European and the American is you're more hedged one-to-one if you're using the American style options on the individual underlying. An argument can be made there that if you have 30 stocks in a portfolio with $100,000, that your activity would be higher and more frequent if you're using the American style. But the trade-off is you get a more direct hedge. You're hedging Apple stock with Apple calls and Apple puts versus 3% of your portfolio is in Apple, and you're using the SPX or the Qs or whatever the index is to hedge it. You're going to be trading something off, and at a level of the portfolio size, the amount of time you're going to put into thinking out the strategy on what time is better. If you're not managing a really big amount of money, the hours and hours of research that you put in, it's not going to make the time to worth it to decide. So I am of the keep it simple camp. If you're looking at every penny to the T, which you're taught to do, I think at some point, if you're not managing enough money, that the payoff isn't going to be there. If you decide to go American or European in any case. So I don't know if that helps. I don't even know if that's an answer as much as I'd probably just find something quarterly that I was comfortable with the yield on, and not worry about what I could be making in the shorter time period, because even the shorter time period, there's a trade-off. So you might have a more positive return because the dividend isn't taken out as much in the shorter term, but then you're trading that for more exposure to gamma. So if you're not experienced with what gamma can actually do to a hedging portfolio in the short term, you may learn a couple lessons there that may cost you more than the benefit that you got on the dividend for going on a shorter term. So I don't know if that's an answer. That's just my diatribe of understanding what the question meant, I guess.
We always welcome your diatribes here, Mr. Kavanaugh. Mark, same question for you. I guess you can really break this very long question down into two components. First off, there's the American versus European debate, I guess you can say, whether that change in premium merits using one versus the other when you're missing out on all the dividends. And then the other side of that coin is, in a scenario like this, doesn't matter what the name is, but in a scenario like this with a high dividend yield, do you think it's worth doing the quarterly every 3 months to capture that dividend versus just buying the leap and kind of letting it ride and getting what you get?
Well, I mean, for starters, does this guy actually think that the market hasn't priced out the dividends properly? I mean, edge is so tight in the option markets right now that there is no way that less transaction costs, that there's any edge in one versus the other. That would be arbitraged out immediately. If there is any edge, I can promise you that this particular advisor doesn't have the cost structure to take advantage of it. You literally need to be a market-making firm or a high-frequency firm with just incredibly low latency and super cheap rates in order to catch any advantage there. Now, in terms of the strategy, our approach is always going the longer term and going with the longer-term trade. There are positive negatives of both. It really depends on all the other mitigating factors of your shorter term strategy as opposed to your longer term strategy. That's I hate to sound so ubiquitous, but that's the truth, is that it's not a simple answer. You really need to know, the details of how one approaches the shorter term trade versus the longer term trade is really what makes one work versus the other.
That's true. There are a lot of devils in these here details. Sounds like you said, Mike, this listener, I should say, is pretty savvy from the mathematical components of an options execution perspective. So it seems like he might be willing and comfortable to take on the added encumbrance of doing this, of rolling every quarter. And I agree with you, Mark, that the European versus American thing, not really much of an issue. But if he does feel like he can capture a little bit of a bonus by executing on a quarterly basis, and he's not intimidated by that extra amount of work. I know a lot of advisors typically want the least work possible, set it and forget it, buy a leap and be done. If he's not intimidated by that, and he's also aware of the gamma component that Mike Cavanaugh mentioned, where you could get whipsawed a little bit more aggressively and end up losing a lot more from the gamma than you do gain by gaming that dividend, then I think he's very savvy to be executing in this sense. And, some people, it really depends, like you said, Mark, on the end user, how savvy they are, how comfortable they are trading on a regular basis, and their execution setup. But it sounds like he has the wherewithal to be able to execute on that quarterly basis and be able to capture that dividend on a more reasonable time frame. So it sounds like you've done the homework and you're aware of all the potential downsides, figurative and literal, and you could handle what comes your way. So these are the kind of questions we love. I wish we could spend a whole episode debating this kind of stuff. Unfortunately, we don't have that much time. But hopefully we at least touched on the salient elements of this question. Eric, anything to add here before we wrap up?
I was amazed that Greg was able to type that question. Boy, I had to literally stop for a second and drink a cup of coffee to read through that whole thing. But I agree with Mike, with Mike and Mark. I mean, obviously, sophisticated question, and clearly he understands this. You have a great audience, Mark. I will tell you, they are way ahead of the curve, and I think that's why you have great outreach, because these are sort of the individuals that are leading the charge.
And I will say this, Greg, you are doing the right thing using stock replacement. I love to see that. More of our audience should be using that. It's a very, very simple strategy. As you've seen, it can be a little more complicated the way you roll it, but it's a very cost-effective strategy. It utilizes your capital much more efficiently. And all the listeners to this show should take a lesson here from Greg. You can use options in so many different ways. It doesn't have to be overboard. It doesn't have to be crazy complex. You can utilize relatively simple strategies like stock replacements, like short puts to get into long stock positions, like covered calls and collars and things like that. If you utilize just these simple components, you're ahead, as we've seen from the data, you're ahead of the vast majority of mutual funds out there who aren't even doing that. And unfortunately, that is all the time we have for this episode of The Advisor's Option. But before we go, let me check in really quickly with each of my cohorts, my partners in crime here on the panel, see what they're working on, what they're cooking up over there in their respective necks of the woods. Until the next time we gather together here on the Advisor's Option program. Eric, we'll start with you. I think you've teased it already. You've got the big advisor study coming out very shortly. What else is cooking up over in the land of OIC Advisor?
Yeah, I also wanted to mention, Mark, we're excited actually to have Mr. Sebastian and some other colleagues of ours joining us in Vancouver. But starting this week, I'm going to be kicking off a program that we're doing with the TMX, Toronto Montreal Exchange, where we're coordinating with them. The OIC and the TMX are going to be hosting a 3-city tour in Toronto, Montreal, and Vancouver over the next couple of weeks, which is exciting for us to bring the two borders together and talk to advisors about how options can generate revenue and expand their practices. And as I mentioned about the Bellamy study, that we will be looking to release that in June, hosting another event with our colleagues at the ICE NYSE Exchange. That will be on June 12th in New York City. Mark, hope you will join us there, as well the other Mark and Mike, hopefully to join us in New York for that. And the last thing I will just throw out there in terms of this conversation about the mini contracts, this goes out to my exchanges. I know we're thinking about this in Chicago. If we see some more names that come about in this space, I do believe that we will get more reception from the retail audience as well as from advisory.
Now, Eric, I know when you're lying because no one is ever excited to have Mark Sebastian show up for anything.
Oh, how dare you!
I am just kidding.
How dare you!
We are very excited to have him on the show. And we're so excited, Mark. Why don't you go ahead and tell us what you're excited about over there in the land of Swan Wealth Advisors?
Things are great. We just, like I said, we just had a new hire start today. Welcome aboard, Justin. You're awesome. And Swan Re, that's our big push. It's live. It's trading. We're really excited about the product, and it's just really neat to be involved with that. And finally, I'm looking forward to. I'll be in Vancouver in April, and then anything beyond that, that'll be fun. And that's the big what we're working on here.
And Mr. Cavanaugh, last but not least, you have many irons and many fires over there: IRAs, 401ks, RIAs, all the acronyms I could possibly think of. Why don't you give us a quick overview of what you guys are working on over there at RCM?
Yeah, I mean, probably our biggest push. We just recently signed on with the Chicago Mercantile Exchange, McGladrey, Rothstein and Cass, and Millennium to do a multi-city, multi-state educational series for registered investment advisors and family offices and high net worth individuals to introduce them to the trusted advisors in the space, the custodians, the attorneys, the accountants, the administrators, as well as emerging managers in the alternative investment space. And when I say alternative investment, I mean more along the lines of the D word, the derivatives, commodity trading advisors, people that use options to hedge, people that have 40 Act funds. So our next event is in San Francisco the last week of April 24th and 25th. We'll be at the Omni Hotel. Got 4 really good managers that are going to be on the panel discussing their strategies, as well as 4 very in-tune advisors in the space. So we're very excited about that. Our 6 cities tour starts in April, and we'll be in a city near you in 2014.
And on behalf of Mr. Kavanaugh, Mr. Cott, and Mr. Sebastian, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this show. And, of course, for writing in with such great questions. Keep them coming. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.